Greetings, members, one and all of the Salivation Nation. An unusually uncertain outlook, according to the Bank of England. Looks like that negative interest rates may be under consideration. There's some cracks in some of the positive news we've been hearing from the economy, and that's what this video is about. Let's explore! Yes, Bama17NC sent me this information from this article from CNBC, and it's very interesting indeed. This is going to trouble some people, especially when it's coming from such a big entity as the Bank of England, about unusually uncertain economic outlook here. Let's get right into the article here. The Bank of England on Thursday left interest rates unchanged. Of course, we saw that as well with the Federal Reserve here in the United States as well, and maintained its current level of asset purchases, but warned that the outlook for the economy remains unusually uncertain. We didn't get quite that level of concern from the Federal Reserve, but all members of the Monetary Policy Committee voted to keep the main lending rate at 0.1%, with the central bank having cut rates twice from 0.75% since the beginning of the pandemic. The MPC also voted unanimously to maintain target for the total stock of its bond purchases at about $968.8 billion, equivalent to £745 billion. The Bank of England also revealed that the MPC has been briefed on the bank's plans to purchase how a negative bank rate could be implemented effectively, meaning it is now openly considering how to use negative interest rates. That's key here, folks. This means that they're really considering that, they're in trouble. Now, here in the United States, that notion has been brushed off by Fed officials, the Board of Governors, even Mr. Jerome Powell. But we'll see how this thing works out as the time goes on, because there's a lot of interconnectivity with markets around the world. So this is why we should be paying attention. If the Bank of England is considering this, well, it may not be long, because most economies are hurting. And yes, there's been some recovery, and we should certainly make note of that and celebrate it. But there's still a lot of underlying issues that are at play here, for sure, around the whole world, but especially here in the United States. So it's the sterling pound, it fell by around 0.6% against the dollar in the wake of this announcement. Britain faces concurrent risk of a no-deal Brexit in spite of coronavirus cases, leading to the reintroduction of some social restrictions and the end of the government's furlough scheme next month, which had supported millions of dormant workers through the pandemic. After plunging a record 20.4% in the second quarter to officially enter recession, the UK economy saw signs of a recovery, with a 6.6% monthly expansion in July, after nationwide lockdown measures were gradually lifted. However, a spike in cases to more than 3,000 per day has forced the government to implement new rules on social gatherings and implement localized lockdowns in certain regions, casting doubt over the country's recovery. The recent increases in COVID-19 cases in some parts of the world, including the United Kingdom, have the potential to weigh further on economic activity, albeit probably on a lesser scale than seen earlier in the year, the bank said in its summary. It added that there remains a risk of a more persistent period of elevated unemployment than in the central projection. Despite stronger than expected domestic economic data in recent months, the central bank said the economic outlook remains unusually uncertain. Those are strong words, as its central assumptions include a free trade deal with the European Union coming to effect on the 1st of January and a gradual dissipation of the impact of COVID-19. The MPC also said it does not intend to tighten monetary policy until there is clear evidence that significant progress is being made in eliminating spare capacity and achieving the 2% inflation target sustainability. Vivel Paul, UK chief investment strategist at BlackRock Investment Institute, said that the employment figures to date do not tell the full story given recent headlines about the amount of British firms considering redundancies, and expects the headline unemployment figure to rise materially in the fourth quarter. The global policy revolution, where central banks and governments have taken unprecedented measures to support economies, and of which the UK's furlough scheme is a prime example, has been the bedrock of a strong risk asset rally in recent months. But the potential for premature withdrawal of stimulus is a big risk to markets and economy, Paul said. The Bank of England and the UK government face the inevitable choice between either being accused of premature policy withdrawal or having extended stimulus to the point that it becomes incredibly difficult to unwind in the future. In fact, we are closer now to basically a universal basic income than we've ever been in the history of probably both nations. All this stimulus stuff going on, it's insanity. He added that if Brexit talks collapse or COVID-19 cases rise significantly through the winter, calls for further intervention will become stronger. And now these negative rates come back into play. Giles Coughlin, chief currency analyst at HYCM, anticipates that negative rates could be seen in February of 2021. That's only a few months away. And the bank now projects that third quarter GDP will be around 7% below the level seen in the fourth quarter of 2019, slightly stronger than previously expected. With Brexit risk ahead of the Bank of England, further possible headwinds, they said that investment intentions remained very weak and uncertainties among businesses were elevated. All in all, this is the bank preparing for tough days ahead, especially as job redundancies could rise to 735,000 this year, according to the Institute for Employment Studies after a Freedom of Information request obtained by the BBC. Now, I made a mention earlier how this is scary for around the world, really, because many central banks, if it can happen in England, it could happen in many other central banks, including the U.S. However, notwithstanding, we have the unusual situation with Brexit that is putting a cog with things if they're not come up with an agreement on how to leave. I guess a deadline is looming there, and of course, it's been kind of it's been a very big struggle since they voted it out in 2016 to leave the European Union and reestablishing trade deals, and then COVID hits, which has already taken an already delicate situation and made it even more delicate and vulnerable economies there. So it certainly is something that is troubling. But you know what? For you Brits out there, well, this is something that should give you all the more pause and confidence that holding gold and silver to protect you against situations such as this. Very, very interesting indeed, and something to consider. Now, what about this situation about this liquidation, this liquidity, this injection of money into the central banks around the world? Well, you think about it, but you think about all the money being printed per capita. Well, what about that per capita? There's a demographic trigger that and that it can be spotted from this, and this comes to us from a Zero Hedge. Share with me again by Bama17NC. This is interesting indeed. And basically it talks about how that the central bank balance sheets are on a seemingly endless march upward in the years ahead. We agree that with what he says next, namely that COVID-19 was just accelerated a trend that was already likely in place, for sure. We saw it before with the repurchase agreements between central banks, the Federal Reserve printing money like it's going out of style between these banks. It was a convenient scapegoat, COVID was, for the epic global liquidity eruption, which allowed both central banks and politicians to kick the can for a few years with the aid of helicopter money and modern monetary theory, which really is nothing new. There's nothing modern about modern monetary theory. The Weimar Republic, Zimbabwe, and even the United States to some degree in the past have been doing this for quite some time. And we're just taking it in overdrive. The only thing modern about it is the volume. Flooding the world with so much debt that there's no longer a credible end game for sure. So this author, Jim Reed, makes an interesting observation, one which fuses debt and demographic trends together into one fatalistic amalgamation that virtually assures the world is doomed. One reason is that the developed world has seen a kind of debt pyramid scheme in recent decades that came to an end around the turn of the 2010 decade. Before that, there had been a long multi-decade trend of an expanding number of workers in the population in absolute terms and relative to the old. As such, accumulated debt was less of an issue as there was always a bigger group in a demographic chain to pay off the debts of the previous and current generation. So that is the key. The thing here, however, as it shows in the chart below, since 2010, the demographic trend reversed, and as such, the pyramid has a problem. That means that unless the authorities are prepared to allow debt to default, they are not, as that would mean the entire global equity tranche is also worthless, or tranche, or make major increases to retirement ages, especially unlikely, but although, age 67 now tends to be the norm here in the U.S., then they need to continue to plug the gap by printing money and allowing debt to look more sustainable than it would be in a free market. As Reed concludes, in a world where central banks can't print babies, but can certainly, it's a case of printing money to keep the ever-increasing debt alive rather than making enough babies in the previous generation to pass on the burden. So there you go. Let's take a look at this chart here. So in the blue, you have the G10 central bank balance sheet size in trillions of dollars. We can see how that's going up. And then in the blue, you see 14 to 64-year-olds as a percent of overall population in industrial regions inverted. There you go. And you can see here that bank balance sheets are highly exceeding, growing out there. To this, all we can add is that while the Fed mercifully can't print babies, it certainly can paradrop money to Americans to motivate them to have babies. In fact, alongside freshly printed monetary reparations to disadvantaged minorities in the U.S., we are confident that this will be one of the Fed's final endgame options before it all comes unglued. A Hail Mary of sorts to just dump a bunch of money on the people. And really, that's kind of what's happened with this coronavirus relief money, is it gave $1,200 to everybody and extended unemployment. People were making more money not working than they were when they were working, giving them more time to sit around and not stress and maybe have a few children, a few kiddos out there. The coronavirus baby boom. You never know. But one final thing. Will that be enough? We shall see. Nonetheless, in either case, no matter what the case, both these stories here, what is the solution? Well, to protect your monetary assets with sound money. That's right. Sound money for the sound mind. That's you. That's even me, believe it or not. So I hope you enjoyed this video. Thanks again to Bama17NC for sharing these stories with me. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.